So the timeline and modes for typical startups to raise funds are such that the first round is almost like a friends and family round where they may raise a couple of lakhs from a bunch of people, which may help them initially develop their product and figure out a product market fit. Then of course comes angel investors who collectively about 4, 5, 6 or 7 of them may pool in some funds and provide it to the startup initially. That would be your angel round or say a small seed round. Then, of course, at a later stage comes a Series A round, where institutional VCs come together. There would be a lead investor and maybe 2, 3 bunch of other VC institutional investors who are collectively pooling in money to invest in a startup. Now comes the question of when is the right time for a startup to raise venture debt funds and not venture equity funds. So VC equity works very differently than VC debt. Here's understanding why and how. So firstly, looking at the suitability of startups when venture debt may be necessary or important for you, or you're suitable enough, eligible to be able to raise such funds. So how venture debt works is it normally works for startups who've already raised their Series A round and are looking at Series B in about 5 quarters. So they would have typically raised about 3 to 4 million US dollars or 20 to 30 crores in India. That's the amount of fundraise that you've already done. And you've also reached a unit economic positive model where, of course, the amount of burn that your startup has, you're scaling growth using that money by building a better quality team, which is more expensive, by spending on marketing. However, on a unit economic level, you're able to generate some amount of positive contribution from the sale of your product. So that's a good time to be able to consider this. Now, what is the quantum at this size of a startup of what kind of venture debt can they raise? Typically, the amount would be, say, something between 3 to 6 crores at this scale. And this fund would be used for not for scaling up, but primarily to bridge certain financing gaps, such as to be able to use money for working capital requirements. Now, typically businesses approach banks for working capital needs where they need money to be able to stock up a better inventory, or maybe they already have a SaaS technology product which is unit profitable. However, they're also developing a new vertical within the same product and they need some funds for product development. At this point, banks would still not fund you because banks typically require an asset as an hypothecated security basis which they extend funds to you. But a VC debt fund at this point would think that, of course, there's a VC equity firm which has already validated your idea. You've reached the stage of Series A. They would try to see that, okay, is it typical for the founder, or is the founder capable of being able to raise a Series B in about 12 to 18 months? Do they have sufficient cash flow to be able to sustain them for about 12 to 18 months? And whether they're unit economic positive. Now, the benefits of this are, one, of course, there is no dilution in your equity, which is a very important benefit because, as you would know, equity is the most expensive form of financing for any business. So venture debt at this point comes in without taking any equity dilution. They, of course, may be interested in taking some nominal amount of equity in your company, but regardless, even if they don't, they're essentially looking at unit positive cash flows. So there will be no dilution on your cap table, which is something that your VC investor may also prefer, because after a point, when there have been a huge number of angel investor or friends and family initially putting money in a startup, your VC investors at a later stage may want a cleaner, leaner cap table with not as many names. So this is a way for you to raise funds without having more equity shareholders. At the same time, of course, the DD process is much leaner because venture debt funds depend on institutional VC equity firms to be able to have done their DD at the time of Series A before extending those funds. So this is the typical use case where these funds can be raised, may be of use. The cost of these funds may come to anywhere about 14 to 15% currently in India, which of course seems exponentially higher in comparison to the rate at which banks lend. But of course, you should also know that the VC debt fund is taking substantial risk because it's not really hypothecating any asset. Now, the term sheet may have these debts either repayable or maybe convertible to equity at a later stage, depending on certain conditions. If the startup is unable to repay, or they think that the startup is actually quite profitable, they might want to convert it to equity. They would typically want to retain that option. Now, you should also remember that with VC equity firms, they normally have the capacity, or the mental preparation to be able to write off 40% of their total assets, thinking that these investments may actually go bad and the businesses may not escalate or scale up or turn profitable as we would have expected or wanted them to. However, for a VC debt fund, they may not really have the capability of writing off more than 5% of their assets. So, which is why Series A to Series B, if you've raised roughly between 20 to 30 crores or 3 to 4 million US dollars in your startup, you have easily about a year or 18 months to go for your Series B. You need funds for working capital or for new product development, and not to hire expensive resources in your business, or not to burn money in marketing costs. That's when series venture debt funds and that kind of money may be of need to you. Share it with someone who may need it.